Imagine opening your investment portfolio, and it's just a sea of red.
Yeah.
That feeling you get, that knot in your stomach, we've all been there.
Right.
Market downturns are stressful, no doubt about it.
Absolutely.
But before you hit that panic button, let's talk about why market volatility is actually completely normal
Yeah.
and how understanding this can benefit you.
It really is like the ebb and flow of the tides, you know? Imagine if markets only went up, right? That would be like some kind of perpetual high tide
Yeah.
with no chance for the beach to breathe.
Right.
Markets historically experience declines about 30% of the time.
Oh, wow.
Those red days, they're not anomalies. They're all part of a natural cycle.
Those more like breathing then. This kind of like natural rhythm of ups and downs.
Precisely, yeah.
Okay.
Now, instead of fixating on those daily dips, let's shift our focus to the long game.
Okay.
Trying to time the market, buy low and sell high.
Right.
Sounds great in theory,
Yeah.
but in reality, it's nearly impossible, even for seasoned professionals.
Right. It's like trying to predict when a wave will crest.
Yes.
You might catch a few, but you'll likely get wiped out trying to time every single one.
A perfect analogy.
Yeah.
The real power comes from staying invested over time.
Okay.
This is where the concept of time in the market beats timing the market. This is where it really comes to life.
Okay.
Compound interest is the secret sauce here.
That's the snowball effect that everyone talks about.
Exactly.
Consistent investment, even small amounts, can lead to significant growth.
Exactly. Think of it as planting a seed.
Okay.
It needs time to take root, to grow,
Right.
and eventually to bear fruit.
Of course.
You wouldn't dig it up every single day to see if it sprouted, would you?
Good point.
No.
Patience is key.
Absolutely.
But what about when the market isn't just fluctuating? What about when it's really taking a nosedive?
Yeah.
How do we shift our mindset to see those downturns, not as something to just endure, but as potential opportunities?
That's where value investing comes in.
Imagine a high-quality company, a leader in its field,
Right.
suddenly becomes undervalued during a market dip.
Yeah.
It's like finding a designer suit at a thrift store.
Right.
The quality is still there, but the price is temporarily slashed.
So we need to train ourselves to see those fire sales for what they are, a chance to buy great companies at a discount.
Precisely. But remember, we're not just chasing low prices. We're focusing on the fundamentals. Strong financials, consistent earnings,
Yeah.
and a healthy dividend payout.
Okay.
Look for companies that have weathered past storms and have emerged even stronger.
It's like finding a ship that's been through rough seas, but it's still sailing strong, a testament to its resilience.
Excellent comparison.
Yeah.
Now let's explore some practical strategies to help you navigate turbulent markets.
Okay.
One approach is dollar cost averaging.
Okay.
It's simple, yet effective.
Yeah.
You invest a fixed amount at regular intervals, regardless of market conditions. So if the market dips, you're buying more shares at a lower price, and when it rises, you're buying fewer shares at a higher price.
Exactly.
Okay.
It's a way to average out your purchase price over time,
Right.
reducing the impact of volatility.
That makes sense. It's like setting your sails to catch the prevailing wind, no matter which way it's blowing.
Right.
What about building a cash reserve? How does that factor into navigating a downturn?
Having a cash cushion is like having a financial life preserver.
Okay.
It gives you peace of mind and flexibility. If a fantastic buying opportunity arises during a downturn, you're ready to act without selling other investments at a potential loss.
It's like having dry powder ready to deploy when the perfect opportunity presents itself.
Precisely. And let's not forget about dividends.
Okay.
They're a steady stream of income even when the market is choppy.
Yeah, it's like having a reliable anchor in a storm. It provides stability and it helps you weather the rough seas. But I've heard that focusing on dividend growth rather than chasing high yields is crucial. Can you elaborate on that?
Absolutely.
Okay.
Consistent increases in dividends often signal a financially healthy company with a solid track record. Look for companies that are committed to sharing their profits with investors.
Okay.
It's a sign of confidence in their long-term prospects.
It's like looking for a captain that not only navigates the ship well, but also shares the spoils of the voyage with the crew.
Exactly.
Speaking of staying the course, let's talk about the psychological side of investing.
Okay.
How do we manage those inevitable waves of fear and greed that can wash over us, especially during a downturn?
Fear and greed are powerful emotions.
Yes.
But they can lead to impulsive decisions.
Right.
And impulsive decisions rarely lead to long-term success in investing.
They're like sirens, luring sailors onto the rocks.
Yes.
We need to be aware of their call, but resist their pull.
A fitting metaphor. The key is to have a predetermined investment plan and stick to it, even when the market throws tantrums.
But it's so easy to get caught up in the headlines, to feel that urge to react.
It is, and that's why it's crucial to remember why you started investing in the first place.
Okay.
What are your goals?
Right.
What are you working toward? Keep those goals at the forefront of your mind.
Okay.
And it'll be easier to stay the course, even when the waters get rough.
That's a great reminder. It's like having a compass to guide you through the fog. You might not see your destination clearly, but you know you're heading in the right direction.
Exactly.
Yeah.
Yeah, it's like having that North Star to guide your investment journey. Now let's add another layer of resilience to your portfolio diversification. It's the age-old wisdom of not putting all your eggs in one basket, but apply that to your investments.
So spreading your investments across different sectors and asset classes helps minimize the impact if one area takes a hit.
Exactly. Think of it like a well-balanced meal. You wouldn't just eat one type of food, right?
Yeah.
You need variety to get all the nutrients you need.
Yeah.
Your portfolio is similar.
Okay.
A mix of stocks and bonds, and maybe even some real estate or commodities, can smooth out the bumps on your investment journey.
It's like building a sturdy ship with multiple compartments. Even if one gets flooded, the entire vessel won't sink.
A great analogy. Now imagine you've carefully crafted this diversified portfolio. Over time, some investments will naturally outperform others.
Right.
That's where rebalancing comes in.
Okay, so we're talking about periodically adjusting our portfolio to maintain our desired asset allocation. Over time, some investments might grow faster than others, throwing our original mix out of balance.
Precisely. Rebalancing involves selling some of your winners, those investments that have performed well, and using the proceeds to buy more of your laggards, those that might be temporarily undervalued.
So it's like pruning a garden. You trim back the overgrown branches to encourage healthy growth across the entire landscape.
Exactly. It's a disciplined approach to staying aligned with your long-term goals and potentially capitalizing on market fluctuations.
It sounds like all this ties back to a fundamental principle, staying calm and rational during times of market volatility. It's easy to get swept up in the frenzy, but that often leads to poor decisions.
You're absolutely right. Fear can drive you to sell everything in a panic, while greed can tempt you into chasing the latest hot stock or risky investment. Neither approach is conducive to long-term success.
It's like being caught in a rip current.
Yeah.
You have to stay calm, conserve your energy, and swim parallel to the shore until you're out of the danger zone.
A perfect analogy.
Yeah.
So how do we cultivate that sense of calm amidst the storm?
Right.
First, remember that market downturns are a natural part of the cycle.
Yeah.
They've happened before.
Of course.
And they'll happen again.
Yeah.
It's like acknowledging that winter will eventually come, so we prepare by gathering firewood and ensuring our homes are well insulated.
Preparation is key. It's about anticipating the inevitable and having a plan in place.
Exactly. Another crucial point, focus on your long-term goals. Why did you start investing in the first place? What are you hoping to achieve?
Yeah.
Keeping those goals front and center helps you stay the course
Okay.
and avoid making rash decisions based on short-term market noise.
It's like having a blueprint for building your dream house. You might make adjustments along the way, but you always refer back to that blueprint to ensure you're creating the home you envisioned.
And remember, if you're feeling overwhelmed or uncertain, don't hesitate to seek guidance from a qualified financial advisor. They can provide personalized advice and help you navigate these challenges with confidence. Now let's dive into some historical perspective. Looking at the S&P 500, a broad market index representing 500 of the largest U.S. companies, reveals a fascinating pattern.
History often offers valuable insights. What does the S&P 500 tell us about navigating market downturns?
The S&P 500 has averaged around 10% annual returns over the long term, even with major crashes like the one in 2008, the COVID-induced crash in 2020, and the tech sell-off of 2022. Imagine, even after enduring those storms, it still delivers a solid 10% per year on average. That's the power of the long game.
That's a testament to the resilience of the market.
Every major crash has been followed by a recovery, often reaching new highs. It underscores the importance of staying invested, riding out the turbulence, and trusting in the long-term upward trajectory. Now let's translate this historical perspective into practical actions. Resist the temptation to constantly check your portfolio during a downturn. Review it periodically to ensure it aligns with your long-term goals, but don't obsess over daily or even weekly fluctuations.
So it's not about burying our heads in the sand, but rather about finding a healthy balance between staying informed and not getting caught up in the short-term market noise.
Remember, we're long-term investors, not day traders, trying to time every ripple in the market. Speaking of long-term thinking, let's revisit the concept of value investing and focusing on company fundamentals rather than just the stock price.
So we're looking beyond the temporary dips and focusing on a company's financial health, its management team, its competitive advantage, and its long-term growth prospects. It's about separating the signal from the noise.
You got it. Look for metrics like low debt, strong cash flow, and market leadership, indicators of a quality company likely to weather the storm and emerge even stronger. It's like assessing a building's foundation. You want to ensure it's solid and can withstand whatever forces come its way.
So we're looking for companies with strong fundamentals, the ones that are built to last. Now, what about those unexpected financial bumps in the road that life throws at us?
That's where having an emergency fund, a cash reserve separate from your investments, becomes a crucial safety net. If you face a job loss or a medical emergency, you're not forced to sell investments at a potential loss to cover those costs.
It's like having a spare tire in your car. You hope you never need it, but it's essential to have just in case.
Exactly. It's about having that financial buffer to protect yourself and your long-term investment strategy. And speaking of protection, let's talk about sector rotation.
I've heard about that. It involves shifting investments towards sectors that tend to perform better during uncertain times, right?
Precisely. Some sectors are considered more defensive, like consumer staples, which include things like food and household goods and utilities, which provide essential services like electricity and water.
They tend to hold up better during downturns because people still need to eat and keep the lights on regardless of the stock market's mood swings.
Exactly.
Yeah.
Shifting some of your portfolio towards these more defensive sectors during turbulent times can potentially soften the impact.
It's like having a diverse wardrobe for different weather conditions. You wouldn't wear a swimsuit in a blizzard. You adapt your attire to the environment.
Now let's explore a strategy we touched upon earlier, trimming weaker positions to make room for stronger ones.
This involves taking a hard look at our portfolio and identifying investments that aren't living up to expectations or no longer align with our long-term goals. It can be tough to let go of an investment, even when it's underperforming.
It can be, but sometimes it's more prudent to cut your losses and reinvest those funds in companies with stronger fundamentals and brighter prospects.
So we're actively managing our portfolio, making strategic decisions to ensure it's positioned for long-term growth.
And that brings us back to the critical importance of staying calm and rational during market downturns. Remember, market downturns are normal. They're opportunities for growth and learning. Don't let fear or greed cloud your judgment.
It's about seeing the forest through the trees, focusing on the long-term growth potential, rather than getting caught up in the day-to-day fluctuations of the market. I feel much better equipped to handle whatever the market throws my way.
That's what we aim for. Knowledge is power, especially when it comes to investing. By understanding the cyclical nature of markets, focusing on the long term, and adopting sound strategies, you can navigate these periods with greater confidence and potentially use them to your advantage.
It's about turning those periods of market uncertainty into opportunities for growth and learning. It's about seeing the potential where others see only fear.
Precisely. Now, before we wrap up, I want to leave you with a thought-provoking question. If everyone is selling in a panic during a market downturn, who is buying?
That's a great question. It suggests that someone must be seeing value where others see only risk.
Exactly. It highlights the importance of independent thinking and not blindly following the herd. Sometimes the greatest opportunities arise when others are heading for the exits.
It's a reminder that market sentiment can be a powerful force, but it doesn't always reflect the underlying reality. By staying informed, doing your own research, and thinking critically, you can develop your own perspective and make decisions that are right for you and your long-term goals.
Yeah, it reminds us that market downturns can create really unique opportunities for those who are prepared and willing to think a little differently.
Precisely. And that brings us back to one of the most important points we discussed today, the psychological aspect of investing.
Right.
Market downturns can be emotionally challenging,
Yeah.
but it's crucial to remember that they're a normal part of the cycle. Don't let fear or panic dictate your decisions. It's about staying calm, sticking to your plan, and focusing on the long term. It's easy to get caught up in the short-term noise, but that's rarely a recipe for success in investing.
Exactly. Remember, investing is a marathon, not a sprint.
Right.
By understanding the historical patterns of markets, embracing volatility as a natural occurrence, and adopting sound strategies, you can navigate these periods with greater confidence and potentially even use them to your advantage.
This has been an incredibly insightful conversation. Thank you for sharing your expertise and helping us reframe our thinking about market downturns.
It's been my pleasure.
Yeah.
Remember, knowledge is your greatest asset in the world of investing. Stay curious, stay informed, and stay focused on your long-term goals.
And to our listeners, we hope this conversation has empowered you to approach market downturns with a more informed and confident perspective.